I'm going to draw on my experience as a CPA and a CA, and also as an investor who worked for the Ontario Teachers Pension Plan, and then for a Dutch-based pension fund called PGGM. I'll also draw on a bit of my more recent experience that was mentioned in the introduction. Let me say that I had to read the title of this talk probably about 100 times because it's not intuitive to me. And so I'm going to be reaching really deep to try to think of ways that, and suggest some ways that accountants can get involved in framing corporate governance, which I think is very important, a very important purpose. Maybe because I am an accountant, I'm going to suggest that accountants need to have a seat at the table alongside lawyers and other professionals. And the reason I say that is because governance goes beyond the law. It absolutely does, and there are many examples of that around the world. The corporate governance codes, and I'm going to talk about that a little bit. Audrey's probably going to speak about that a lot more because they come up in the paper. Codes, unlike that in the UK, where it is codified and is law, they're a soft law approach to governance. They pick up the information gap between disclosure laws and what investors need and want. And there are codes all over the world. So, and I'll say also that these codes are in evolution. There was one that I worked on for maybe 6 years in the US that came out in January of this year. And it's a stake in the ground. It's a starting place for further conversation. Much like GAAP, they're not complete. The information's not perfect. So I think it's important for accountants to recognize what other frameworks for information that investors and other stakeholders of consumers of this information are looking. So the FRC principles started out that way. They are codified, as I said. The Dutch Corporate Governance Code is codified elsewhere. They're more or less comply or explain principles. Migrating now to apply and explain, I noted, King for in South Africa and elsewhere. Okay, opportunities for the accountants in terms of corporate governance. I'm going to talk about 3 things. One is trust. 2 of them, the first 2 are really about the governance of your clients, and the third is about the governance of accountants themselves. And I think you can't really look outside without looking inside as well. And there are a number of governance-related issues, I think, and I will just talk about one of them principally by using an example that came out earlier this summer. We're going to talk about trust, and specifically the lack of trust in business. I want to talk about sustainability factors a little bit and the prevalence and predominance of sustainability in reporting, what investors are looking for and why. And I want to talk a little bit about conflicts of interest. So again, I'm not an academic, so forgive me. You are not going to get any statistically valid studies coming from me. Some of my sample sizes are 1, but you're just going to have to get over it. This is a practitioner perspective. So the Edelman Trust Barometer comes out every year. It's something that some of us do look to get an indication of where things are going. And they surveyed, so this came out in January this year. I'm going to talk about the Canadian results. They survey people October, November. They take the informed public, which is probably all of us, higher education, read the business press, higher income earners, etc., versus the mass population, which is everybody else. So it's about 87% of the population. The big news for Canada is that we have now slipped into the distrust category in terms of all categories. We used to be neutral, historically neutral. We're not anymore. So it is the mass population that's driving this movement, and that is a harbinger of the fact that we are not immune from populism in this country. The informed public, ourselves, are more or less still trusters. But the gap between ourselves and the mass population has doubled since that last year. That's a very important piece of information. It's gone from 7 to 15 points. Least trusted, government and media, followed by business, and finally NGO. Those are the 4 categories they measure. The categories of individuals where trust has slipped the most are financial analysts, followed by CEOs. Financial analysts dropped by 13 points since last year, CEOs by 12, board members by 6, academics by 7 points. Just throwing it in there, nothing to do with governance. Just thought you might be interested. So credibility of business is slipping. Really interesting to me was that the most trusted individuals to deliver any type of financial information and business information are employees. So that is a reflection of the mass population. So that's a bit of a backdrop. The second least trusted person is the CEO. And this also applies to financial earnings. And the CFO and management are going to be considered part of the least trusted group. Interestingly, on industry issues, academics are the most trusted, followed by employees. And then on programs to address societal concerns, they're looking at activist consumers, again, followed by employees. It's not all bad. 3/4 of the respondents do believe that business can have a positive impact. In addition to increasing profits, they can also have a positive impact on the communities that they operate in. And good for Canada is that we're still among the highest globally trusted businesses and countries among the world. So that's ahead of Sweden, third is Switzerland, followed by Germany and Australia. So it's not all bad, but the point is we can't be complacent. And as people that are part of the business network, I think we have to take that information into consideration as we're thinking about governance down the road. So what's the opportunity? I'm specifically going to talk about non-financial opportunity at the moment here, and qualitative criteria, something that's really important to investors, where I think you can have some influence. So you know that now that boards and management are not trusted. And so as individuals who are appointed, auditors appointed by the boards, we heard from Johannes that they're in the board constantly talking to the audit committees. I think that affords accountants and auditors a view into the boardroom and a unique perspective that they should choose to act on. I'm going to say that does not mean going to your consulting arm in a firm and bringing someone in from the governance advisory practice. What I mean by that is not returning a blind eye to governance issues that you observe or encounter in the course of an audit. I obviously was an auditor a long time ago, but I encountered some of these issues and I know that they didn't go very far. That is not okay today, and there's an opportunity to do something about it. So we're talking about board effectiveness here in particular. It's not financial. It's not reported in any meaningful way. It's really difficult to report, obviously, and therefore it's difficult for investors to assess. I will say up front, as someone who just left the investment community a year and a half ago, investors are not about to start trusting any members of management or the board. It's just not going to happen. The horse has left the barn. There's a saying that trust leaves on horseback and comes back on foot. It's going to take time. And I think boards and advisors that recognize this can get ahead of the game. So they're going to have to start figuring out what to do. In the meantime, what you've got is investors testing board effectiveness. And what do I mean by that? If you look at what the large US asset managers have done in terms of staffing up in this past 12 months alone, you've got BlackRock, they've gone from 20 people to 31. Vanguard has gone from 10 to 20. State Street's going to be at full capacity at 13, but they came up from 5. This is all in the last 12 months, and this is all aimed at testing board effectiveness. So engagement is something people talk about a lot. Clearly they're doing it. It's not a panacea. And I did read Audrey's paper. It talks about that engagement will facilitate understanding and support for governance practices. I think that's true part of the time, but it's also investors can be dissuaded from the information they learn from these experiences and engagements. And I'm going to give you a couple of examples. One where it worked in the company's favor and one where it didn't. And in one case, I was speaking to a Fortune 50 company about the decisions the board had made. So I was speaking with the lead director on a decision the board had made in regards to compensation. And on paper, it looked horrible. And none of the proxy advisory firms liked the decision. Went in, talked to the director, and he told me what the process they'd undertaken was and how they were changing things for the new CEO that was coming in. In that particular case, it would have been a vote against, but due to the engagement outcome, it was a vote against our policy and vote in favor of the company. One of the metrics I developed for testing board effectiveness was to find out, and this is particular in the US market, was to ask lead directors how they resolved any conflict between themselves and the chairman and chief executive officer. And out of the tens of dozens of times I asked that question, I only ever got one good answer, and it was from General Electric. And in that particular case, they gave me assurance that there actually was good tension in the boardroom. In other words, the board was effective. Most of the time, it wasn't useful at all, and it caused me oftentimes to vote against that person because they were weak. One time I got this crazy answer that said, well, it's in my blood. I actually thought, are you real? I mean, really. Anyway, so I'm going to say engagement, valuable tool from a time perspective, hugely ineffective. You can't do it across an entire portfolio. So you're really triaging and cherry picking how it is you're going to test board effectiveness. So what all, in God's name, does this have to do with accountants? Again, you're in the boardrooms. You are seeing things that investors and others don't see. So I would say if you have an experience that isn't perhaps leaving you feeling particularly rosy, you ought to perhaps suggest that they undertake a board evaluation. One of my colleagues in today's world, who does a lot of board work, she said that for every board evaluation she does, 75% of the time, for all of them I guess, 75% of the time, there's a change in board composition. Everyone benefits when governance oversight is strengthened. So I think that's an important thing to think about when you're in there. Maybe it's appropriate for the auditors to participate. I don't know. I've never seen it happen. I'm not saying it shouldn't happen, but it's something to think about. What is your role around board effectiveness? It's not a disclosure issue. It is a process issue. It is ensuring that everything you see is properly dealt with. Won't win you favors with your clients, maybe, maybe not. Maybe though you're going to identify something that the board has been struggling with for a really long time, more than likely that's going to be the case, and you're going to help them with a solution. So moving on to sustainability. Last week in Denmark, there was an IFRS presentation where they named that one of the 4 risks to financial reporting is, I quote, exploding sustainability reporting. The other 3 were the gap between book and market value, disclosure overload, and big data and AI. So sustainability reporting, definitely exploding. It's to me, it's one of the biggest threats to financial reporting, in fact, because in numerous cases, when you look at it from a governance perspective, there seems to be incomplete or inaccurate financial information. And whether or not, and I heard Johannes say, we are auditing against a set of accounting standards, I don't think investors really give a crap about that. They want to know that the forward-looking, the company is going to be a going concern, and they do not want to read about VW's emission standards and that the accountants didn't catch that. So we need to talk a little bit about that. And that's not at all what Johannes is looking for when he does an audit. Maybe that needs to change. So there's something that CPA did recently, and I'm going to point you to a piece of disclosure around a report that was on geared at audit committees and helping them understand KPIs. I was part of that group on the advisory committee, and it was really insightful. Clearly there's a lack of comparability across a lot of this data, and I'll give you one example. There's an audit committee member that said that for every company in his peer group that calculates sales per square foot, they all calculate that number differently. We all think we know what sales per square foot means, but the definitions are different. Not cool. Are investors making decisions based on this? Okay, here's my sample size of 1. I asked a portfolio manager who's an active stock picker and said, do you use KPIs? Because they're everywhere. They're everywhere. And she said, no. So what do you use? Cash flows. That's it. Cash flows. Cash flow statement. That's what she looks at. Makes you wonder what else we're doing with all these other ratios and all those other financial metrics. So really, what's the relevance of this data? You need to be asking yourself that. More information? I don't know. Maybe the answer is just better quality information. Let me see. I got sidetracked. Okay, so what does this have to do with governance? In years gone by, before environmental and social issues becoming real, big issues, as we're seeing from day to day now with climate change, I would think of them as in this way, and they would become governance issues to me if they were pervasive and systemic. And if year after year after year things were happening and a company or a board wasn't dealing with them, then they clearly became governance issues to me. Now, that is just mainstream. These are governance issues, and investors are engaging companies on these issues. State Street's just issued their expectations of boards on climate change, for example. World's largest investor, pension fund, does anyone know where they are? Or who it is? You have to know this.
Dutch.
No. Japan, GPIF. 1.3 trillion US dollars of assets under management. Sleeping giant, passive investor, just started getting into private equity investing, quiet. 2016, late last year, they started an ESG group, environmental, social, and governance. They've identified climate change as their #1 priority. They're starting really slow. They asked their external managers to come up with an ESG index for the Japanese market. #2 largest, close, Norway. Second largest pension fund in the world is the largest bank. For years now, they've identified climate change as not just an investment focus area, but an engagement focus area. The large asset managers in the US in 2017, so earlier this year, changed their voting policies on how they're going to think about sustainability issues. That's why the shareholder resolution at Exxon for increased disclosure around climate change passed this year. It's never passed before. I will say that the primary reason that BlackRock changed their voting policy is because they themselves got a shareholder proposal on how they deal with these issues, because they're a publicly traded issuer as well. Yeah. Oh, okay. So opportunities for accountants. Really, on this, I think you need to start thinking about how you work with other professionals. Maybe it's engineers. Maybe if you'd had an engineer in the VW situation, you wouldn't have had that issue. Reputational risk for accountants. So I will leave that. I think you need to start thinking about who you're working with, what you're reporting, and how you're reporting it. I can actually see a time when investors are going to start asking for assurance on some of this sustainability data, and I think you need to be thinking about that as well. On the conflict of interest, does anyone know what happened at the Vodafone AGM in July? Standard Life, a former colleague of mine, Deborah Gilshin at Standard Life, made a statement at the annual general meeting explaining why they voted against the reappointment of PwC and why they voted against the resolution to determine the auditor's remuneration. And this has everything to do with their perception of conflict. They're a large investor. They have about 300 billion pounds sterling of assets under management. They own about 2% of Vodafone. And basically, the issue, very quickly, is that there is a company that Vodafone interacts with, so PwC is the auditor of Vodafone. They also have several PwC partners that are administrators of this other company, and this other company is wanting to sue Vodafone. The issue that Standard Life said is that they had a problem with PwC becoming administrators of this company that does business with Vodafone after they were appointed auditors. And the quote was, well, there were many, but one in particular, confidence in and independence of auditors in the accounting profession has been dented by scandals, many of which are linked to the global financial crisis. And this environment requires the highest standards of probity to rebuild trust. We're back to trust. So whether there's real or perceived conflict, I think it's imperative that you as a profession, we as a profession, start to think about this. And unbelievably to me, which Mark did talk about earlier, you've got investors starting to engage accounting firms. That's exactly what Standard Life did. They went to meet with PwC and talk about this. It doesn't happen here, but it's happening there. And UK is sort of Europe generally, 5 to 7 years ahead of North America. It's going to start coming here. So I'm just going to leave it at that so we can move along and stay on time, and maybe we can talk a little bit more about this after. Thank you very much.